In one of our previous videos, we discussed BlackRock, a giant in the American finance industry, and its request to the SEC to launch the very first Bitcoin spot ETF in the US. As we pointed out, this move could have a significant impact on the market for several reasons. The introduction of an investment vehicle like this in the US could trigger a wave of fresh capital, especially as we mentioned in the video. If BlackRock gets the green light from the SEC, they'll open up a gateway for other big funds to follow suit. Increased access to Bitcoin through genuine spot ETFs could attract new investors and stimulate growth in the sector's market capitalization. Now, for those of you who have been around the block a few times, you're probably thinking that this isn't the first time you've heard this tune. Institutions are coming. Institutions are coming. Since 2017 and 2018, we've been seeing these kinds of headlines come and go. And yes, that's true. But this time, I really think it's different. Given its size and its scope, and its political and economic connections, BlackRock is a unique and major player in the global financial landscape. When BlackRock moves, everybody pays attention. The company manages $9 trillion in financial assets on behalf of institutions and private clients, which gives it a considerable clout. During the subprime financial crisis in 2008, or the crash of the COVID-19 pandemic, who did the government turn to? For some, the American company is now on par with governments. In Fink we trust. For the Game of Thrones fans out there, BlackRock CEO Larry Fink, he's him, Lord Varys, a complex character who always seems to be one step ahead of everybody else. Everyone's left wondering what his real motives are, and if he's truly acting for the common good or simply pursuing his own interests. In short, you get the picture. The launch of a Bitcoin ETF by BlackRock would send a powerful signal to institutional investors, confirming Bitcoin's dominant position and its relevance as a sustainable asset. This would eliminate any doubt about the US's regulatory intentions. No one in the West is going to ban Bitcoin, as some still fantasize about, and in my opinion, the US will definitely be a crypto powerhouse despite all the recent turbulence. Now, many of you expressed concerns in the comments of the last video about market manipulation and potential actions aimed at artificially controlling prices. Could the entry of a Wall Street heavyweight like BlackRock, for instance, have the same repercussions on Bitcoin as those seen in the precious metals market, which is widely known to be subject to heavy manipulation? Could the establishment's aim be to control Satoshi's invention and moderate its price, to then dampen the excitement and euphoria that occurs about every 4 years during each bull market? That's what we're discussing in this video. Alright, the first question we might rightfully ask is the precious metals market more manipulated than others? Honestly, it's really hard to say. There are often dubious dealings in almost every area of finance. For instance, in 2012, several major banks, including Barclays, UBS, and Deutsche Bank, were involved in a scandal manipulating the LIBOR rate used for short-term interbank loans. This rate essentially reflects the trust between banks and directly impacts funding costs for financial institutions. It's set daily in London and serves as the basis for many other interest rates around the world. The banks involved in the scandal were accused of manipulating the rates to maximize their profits or to mask their actual financial situation. Another case, in 2013, revelations surfaced about manipulations in the foreign exchange market, or Forex, again by several major banks, including Citigroup, JP Morgan Chase, Barclays, UBS, and others, basically the whole gang. Traders at these banks were said to have exchanged confidential information and manipulated exchange rates to boost their profits, to the detriment of customers and investors. And then again in 2015, then in 2018, and once more recently in 2021. The same type of scandal can be found in the commodities market. That's why I can't help but chuckle when I hear Gary Gensler, the head of the SEC, talking about the crypto ecosystem in this way.
Hucksters, fraudsters, scam artists, Ponzi schemes, the public being left in line at the bankruptcy courts. We've seen this story before.
Yes, absolutely, Gary. We've seen this before in traditional finance. This is not at all specific to crypto. But jokes aside, let's return to the precious metals market and gold in particular. It's true that this asset, due to its history and role as a financial safe haven and global monetary standard, has a somewhat special status. It's important to understand that the price of gold is an indicator reflecting concerns about the traditional monetary and financial system. Rising gold often signifies a loss of confidence in fiat currencies, particularly the dollar. When everything collapses, you resort to the thing that has been working relatively well for 5,000 years. And that thing is, that barbarous relic, as John Maynard Keynes would say, well, that's gold. So, to prevent panic and ensure the musicians keep playing on the deck of the Titanic, certain institutions have every interest in making sure the alarm doesn't go off. And here, the alarm is the price of gold. The currency war between countries has already started. The last thing the US needs is a gold price of $3,000. The US government doesn't even hide these manipulations. Since the Gold Reserve Act of 1934, signed by President Roosevelt, the Exchange Stabilization Fund has a specific goal to do more or less anything to protect the dollar and the American economy. This includes manipulating the gold market, but also other assets that could pose a threat. And this is not a specifically American practice. William White, a director of the BIS, the Bank for International Settlements, so the central bank of central banks, said in 2005 that international financial authorities regularly collaborate to influence the course of certain assets, especially gold and foreign currencies, when it seems necessary. Again, the big banks have a field day with this. In 2020, the Commodity Futures Trading Commission, CFTC, which regulates the commodity market in the US, accused JPMorgan Chase, one of the largest American banks, of manipulating the metals market from 2008 to 2016, nearly a decade. The investigations revealed that traders were conducting fictitious transactions to influence the price of precious metals such as gold, silver, platinum, and palladium. They used illegal practices such as spoofing or layering. To put it simply, spoofing involves placing a very large and very visible buy and sell order on a market. For example, I publicly announced that I'm ready to buy a massive quantity of gold at $2,500 an ounce, while the current rate is $2,000. This buy order will push the price upwards. Meanwhile, I discreetly sell my stock and make profits. When I'm done, I withdraw my offer at $2,500 as if nothing happened. And it also works the other way around. I place a big sell order this time at $1,500, which pushes the price down, so I can buy it at a more interesting price. And voila, I step back once the operation is completed. That's what spoofing is, and it's been banned since 2010 with the implementation of the Dodd-Frank Wall Street Reform and Consumer Protection Act. As for layering, it's a slightly more sophisticated practice where a trader places several buy or sell orders with the intention of creating a false impression of demand or supply. These orders are quickly canceled or modified before they can be executed. The goal is to give the illusion of intense activity in a market and move prices in a direction that benefits you. But the worst nightmare of the famous gold bugs, those people strongly convinced of gold's value as a store of value, kind of the ancestors of Bitcoiners, is the concept of paper gold. This refers to all forms of investment in gold that aren't based on the direct possession of physical gold. This can take various forms, such as gold futures contracts, derivative products, options, gold certificates, or the infamous ETFs we talked about last time. With paper gold, investors essentially hold securities or contracts representing exposure to gold without actually physically possessing the metal. You have a piece of paper saying that you own X amount of gold, but there's an intermediary, a trusted third party between you and your property. And as you might guess, the biggest issue is the potential to create a supply of paper gold that exceeds the actual supply of physical gold available on the market. It's estimated that there's 100 to 300 times more paper gold than physical gold out there. Even though the Basel III agreements tried to limit these leverage mechanisms with the NSFR, or Net Stable Funding Ratio, it hasn't been very successful so far. So in essence, it's like we're going from 21 million to 2.1 billion Bitcoin thanks, or rather due to, securitization and intermediaries. And actually, this is a bit of what happened with Mt. Gox, and more recently with FTX. These platforms made people believe they were buying and selling Bitcoin when there was absolutely nothing backing them. In FTX's case, it's estimated that there were about $1.4 billion in fake Bitcoin on the platform, which equals around 80,000 Bitcoin, or 25% of the annual production. Of course, this significantly impacts buying pressure. It's basic economics, supply and demand. If FTX had kept Bitcoin in its reserve, this would have certainly reduced the quantity available on the market and thus pushed the price upwards. Now let's be clear, exerting downward pressure on prices works as long as the market doesn't have a strong direction. For instance, if the true price of Bitcoin is $40,000, but it doesn't particularly have a trend, then you can take it down to $35,000, with some financial tinkering for sure. But when a bullish trend starts to take shape, all these small-time subterfuges expose the financial health of the manipulators at work, and they withdraw. We can clearly see this in the gold prices since the mid-80s, and this becomes even more apparent if we go back to the late 18th century. Market manipulations happen on the margins. In reality, manipulating a market amounts to blurring it. Right now, I don't know if gold is worth $2,000 or $1,500. However, I know it's not worth $1,000 or $3,000. Between short-term and long-term, it's the same thing. I don't know exactly what it'll be worth next week, but I know its long-term trend is bullish. From our standpoint, just like with gold, all the derivatives markets in the world and the ill will from anyone won't be enough to constrain Bitcoin's price too far from its true value. Let us know what you think in the comments. Do you agree with our analysis or not at all? We're interested in hearing diverging opinions. There's something else very important. For many people, paper gold was chosen for its convenience. With a gold ETF, for example, you save on storage and transportation costs, and above all in terms of liquidity. It's easier to sell a share or a fund under Giro than to physically go to a store and sell a Napoleon 20 franc gold coin. With Bitcoin, it's very different. When you think about it, a Bitcoin ETF offers very little advantage to an average investor. Given that Bitcoin is already a divisible digital asset, easily storable, recognizable, and transportable, the disadvantages that accompany securitization really don't justify its use in the case of Satoshi Nakamoto's invention. There's no need to introduce a third party between you and your Bitcoin. So to sum up, as we've often reiterated in our recent videos, Bitcoin's short-term price is of very little importance. It's easier said than done, I do agree. But just ask yourself once a year if fundamentally, Satoshi Nakamoto's invention is still progressing towards fulfilling its core promise. Time will do the rest and work in your favor. We're living in historic times of transformation, and it's precisely during these periods that fortunes are made and lost. In any case, one thing is for sure, Bitcoin is a strange beast that will surely continue to surprise us.